Impressed even after very tall expectations was the Yes Bank number, and the most impressive number really there was the growth, 33% growth in loans. One expected that last quarter's 30% was itself a very tall effort, but 33% growth delivered with no really any injury to the asset quality, remains at 0.79% GNPA from 0.76% and largely lending to corporates. So I chatted up with Rana Kapoor after the bank's numbers were announced yesterday, and he says that he can sustain a 27 to 30% growth over the next 4 years. Of course, he's also going to be raising some capital through QIP. All that in this conversation. Listen in.
If you see, last year, which was a very tough year, fiscal 15-16, we grew the loan book at 30%. The fact is that, our overall denominator is still like a medium-sized bank, which is now leaning towards a small, large bank, right? So our growth last year was 30%, and we have reason to believe that with the sectoral and fairly well fine-tuned, segmented, geographic, as well as, sectoral strategies, we have reason to believe that, we can address the credit demand in some sectors, which is, resurfacing. Also,
so this 33 is manageable?
No, I think 33 is not sustainable beyond like a point. But we have reason to believe that next 4 years, which is the third phase of Yes Bank's life cycle of growth, from a small large bank into a medium large bank till 2020, we have reason to believe that we can sustain between 27 to 30% credit growth. And because of the sectoral strategies we have, there's reason to believe that with good credit filters, relationship management, intensified product, penetration, that this can be done.
Okay, so if you can tell me where the growth came from, where this 33% came from.
If you see, fundamentally the growth is coming in from the sectors we focused on literally from inception. Some of them continue to be sunrise sectors like agribusiness. We have reason to believe that in renewable energy, we have a fairly significant market share, apart from substantial market and mind share in that particular business.
But broadly, is it corporate, retail, SME, MSME?
I think it's the engines are all moving because, the interesting thing is that the corporate businesses give us an opportunity because of a proven track record and a relative resilience in asset quality, give us an opportunity with that proven track record to build market share and mind share. At the same time, all the growth engines in what we like to believe in our SME businesses, which is not small anymore, it's 23% of our total advances. And if you look at even the consumer and commercial retail, which is clubbed as, retail banking, is almost inching up to, double digits. It's about 11%. So with the overall branch banking driven growth and strong growth in retail liabilities, and with credit cards, which is the final last month product launch, we are going to be a very comprehensive retail bank in, this year.
Okay, well, maybe credit cards is not something you will feel the absence of once the unified payment interface is up and running. But let me come to other income. That has contributed substantially to your profit. It straight away goes to the bottom line. And the notes to accounts gave us very broad ideas that it comes from guarantees, letters of credit, financial advisory, selling of products. Can you give me a breakup? Did a substantial amount come from sale of securities, investments?
You see, overall, if you look at the composition of our earnings in this quarter, we were approximately 60% driven by net interest income.
Yes, of
and
course.
Broadly, just around 40% by non-interest income. This was a very good quarter because what we are seeing is increased market share on corporate banking and in corporate finance. The reason is that, our branch that we set up in Gandhinagar in the international banking unit, that's giving us new breakthroughs in clients like pharmaceutical sector, which was difficult to compete with when we did not have an offshore loan book.